Hey everyone, the stock market is down, and right now a lot of stocks are selling off due to so many reasons, with inflation going up, the federal government meeting next week to talk about how they're going to possibly raise interest rates to offset some of the debt that they incurred this past year. And of course, with the Russian-Ukraine war, guys, right now there's a lot of sell-offs. A lot of stocks are really, really cheap. And today in this video, I'm going to be talking about how to sell put options a month out to collect income. Okay, so especially in these times right now, it's a great time to, in my opinion, to do the wheel strategy where you sell put options on stocks that you would not mind owning. And then if you get assigned, you would turn around and sell covered calls, or you can simply hold on to the stock at a discount. But before I begin, make sure you like this video and subscribe if you haven't already. If you like this content and you want me to make more content like this, smash that like button. I would really, really appreciate it. Okay, so without further ado, guys, so it really depends on your portfolio size and how much you're willing to invest. But guys, right now, using this wheel strategy, I'm able to collect about $1,000 in passive income just by selling these options. And so I'm going to show you these stock companies that I'm invested in myself. And the first stock ticker is WTI. So WTI is WNT Offshore. So it is in the oil and gas industry, headquartered in Houston, Texas. It's a very, very old company. It has a market cap of $719 million. I do think this is one of the companies that will profit from rising oil prices. If the war continues, then we should see continued upside for the stock. Okay, so I'm selling these options about a month out because I think that's the sweet spot of how much I can collect in premium. I'm trying to aim for about 10% on these put options. So let's take a look at our first stock, WTI. We're selling out about a month out, and we're collecting about $65 off of a collateral of $435. So guys, if you have a really, really small portfolio and if you only have about $435 to trade, that's completely fine. You can start out with something like this and collect $65 in a month. Basically what happens is if the stock continues to go up, then you simply collect your $65 and you walk away with $65. Now let's say the stock goes down. If it goes down all the way to your strike price was $5, then you would get assigned the stock, but you would get assigned at a discount and you would still keep your premium of $65. Okay, so and then once you're assigned, you basically own the stock at $5 a share, plus you get the premium that you collected. And so you essentially would get a number of free shares just from the premium that you collected. Okay, so let's take a look at what happens after you get assigned. So let's say you get assigned 100 shares of WTI. What you would do next is you can simply hold on to those shares, or you can sell covered calls. So the way that covered calls works is if the stock goes up, you will be forced to sell the 100 shares that you own, but you would also collect a premium. So let's say you sell a covered call at $7. Okay, so $7, you would collect $20 just for selling that option, and the stock would have to go up to $7 before you'd be forced to sell. And you would, when you're forced to sell at $7, guys, you're gaining 38% on that position. So you would have made a profit from the upside as well. So really you're profiting from both downside or upside, depending on how the stock moves and where you select your strike prices. So that's basically how the wheel strategy works. So we sell put options and we basically wait and see if we get assigned. If we do get assigned, we turn around and sell covered calls. And if we don't get assigned, then we simply walk away with the premium and we reopen the position. Now, one thing I do want to note is a lot of times, whenever we sell put options, we don't necessarily have to wait 45 days or a month. Okay, so we close out positions well before. So typically a couple weeks out, before the expiration date. And the reason for this is something called theta. Okay, so in every option, there's a Greek system where there's delta, gamma, theta, vega, and rho. And the one we're talking about today is theta. So theta just tells you how quickly the option is going to lose its value as it gets closer to expiration. So as we get closer to the expiration, basically, if you're selling put options, your contract becomes more valuable and you're able to sell at a profit. So usually I would just close out the position about 2 weeks before the expiration and then just reopen another position. Okay, so now that you know how the wheel strategy works, I'm going to show you 4 other stocks that I am bull and long on, and I'm also selling put options on and essentially doing the wheel strategy. Okay, so WTI was the first stock. The next stock is SOFI. Okay, so SOFI is a fintech company, started pretty recently in 2018, but it's grown significantly ever since then. This year, the stock has been down quite a bit. So SOFI is down about 45% year to date. So right now, it is very, very cheap. And so let's take a look at the wheel option for SOFI. Okay, so we're going to go to SOFI. We're going to go to sell put options, and we're going to go out about a month. Okay, so right now we can sell at, okay, so actually, typically we can take a look at different expirations. I want to find one that's a little closer to the money. So let's take a look at this option right here. If we're selling put options out about less than a month actually, and at $8.50, guys, we can collect about $84, which is a little over 10%. And so that is very, very good, great for me. I would definitely sell the put option out to April 8th and collect about $84 off collateral of $766. Okay, so let's say we do get assigned and we collect a premium and we have 100 shares of SOFI. We would simply turn around, okay, and sell covered calls. And right now we can sell covered calls out to $10.50 and collect a pretty good premium at $31. So the stock would have to go up to $10.50 before we would be forced to sell. But at that point, we would profit from both the movement upwards of the stock and the premium that we collected. Okay, so next stock ticker is Palantir. I've talked a lot about Palantir in some of my other videos. So a lot of you who have been following the channel would know that I'm very, very bullish on Palantir. But let's take a look at Palantir. Right now it is trading, it is an AI company, one of the largest AI companies in the US. And it's really at a very, very low price right now. So let's take a look at what would happen if we sold put options out about a month. So right now, if we sold about a month out, we can collect about $88 off of a collateral of $1,012. So that's pretty good. Let's take a look if we sold out to April 22nd. Okay, so we can collect about $96 off collateral of $1,000. So that's still great premiums for the stock. You're collecting almost about 10%. And let's say we do get assigned. If we turn around and sell covered calls, we can sell it out to $13, $13.50, and still collect about $45 on the upside. So that would mean that Palantir would have to go up to about $13.50 for us to have to force to sell the shares, but we also collect $45 and the upside. Okay, so the next stock ticker is NEO. So NEO is another stock that I'm very bullish on. If you're bull on the EV market, NEO is not nearly as close to where Tesla is, but still nonetheless, they have a lot of great things in the pipeline. So let's take a look at selling put options for NEO. If we sold out to about a month out at $15, we would collect about $168 off of a collateral of $1,332. So that is, again, over 10% returns. And if we do get assigned, let's turn around and we'll sell covered calls. We can sell it out to $22.50 and still collect about $58. So that is great premiums on both the downside and the upside. So NEO is another stock that I'm definitely wanting to sell put options and exercise the wheel strategy. Last stock ticker for this video is Cpng. I've covered Cpng, also another one of my videos, and unfortunately it's sold off quite a bit ever since then, but I'm long and bull on Cpng because Druckenmiller, who is a hedge fund investor, he actually transitioned into family office, but before that he had 30% annual return for just decades. Plus Bill Gates and Melinda Foundation have a pretty sizable position in Cpng, And just the fact that I know what Cpng is and what they're doing here in Asia, I am definitely bull on Cpng. So let's take a look at what would happen if we sold put options about a month out. Right now, if we sold at a strike price of $17.50, we would collect about $182 off of a collateral of $1,568. So again, that is over 10% return. Great premiums on that. I do have quite a few shares of Cpng, and let's say if I do get assigned more, I would simply turn around and sell covered calls. I can sell out to $22.50 and collect about $45. Okay, so these are just a couple stocks that I am definitely wanting to own myself. And again, whenever you will do the wheel strategy, you want to do it with stocks that you really don't mind owning for a long time. Because let's say the stock continues to go down, then on the upside, you're not going to collect as much premium, but that's completely fine because ultimately you would just simply have to hold on to these stocks for 1 year, 2 years, maybe not even that long. And eventually, if your thesis plays out and these are solid companies, you're going to make a profit. Okay, so I hope you like this video. If you want me to make more videos like this, where I talk about put options and companies that I'm long and bull on, make sure you like and subscribe to this channel. Until next time, guys, I'll see you around in the next video.
With every star, we are born.